Your market news now. Asian shares were flat, with markets holding on to their gains for the week as confidence grows that interest rates globally will head lower in 2024. Japanese markets are closed for a national holiday, and trading worldwide is expected to be quiet. And this is due to the Thanksgiving holiday in the US. Meanwhile, locally, wholesaler SPY expects its full-year headline earnings to fall by up to 53%, but assured investors that it will not go to the market to raise capital from shareholders. A range of issues has led to this revenue drop, but the biggest culprit was the problems in its new SAP software implementation in KwaZulu-Natal. To give us more perspective on the markets, we are joined by Simpiwe Litlojana, who's an investment strategist at ABSA Investments. Simpiwe, thank you so much for your time. Your general sense of the market, given the fact that we have this backdrop where we are expecting a more benign interest rate environment.
Afternoon, Nastasha. Thank you for having me on the show. Yeah, we are seeing a bit of a recovery in markets. They did have a bit of a volatile couple of months, but fairly strong recovery over the past month to date. And when you're looking at our local markets, you are seeing industrials and financials rebounding fairly strongly, but resources still, being the laggard. And I think generally when you're also looking at global markets, you are seeing them rebounding fairly strongly as well. And markets continue to be driven by monetary policy uncertainty, in particular with the latest US Fed decision to not hike interest rates, really certifying to the markets that we are potentially at the peak of the interest rate hiking cycle. And in fact, we are beginning to see markets discounting the potential for some, future rate cuts coming in slightly sooner than expected. The US Fed, of course, has not started that conversation yet, and in fact has emphasized that potentially another rate hike could still be on the table. But I think markets generally overall really trying to assess the balance of macroeconomic data.
We'll talk about the Fed in a bit, but I want to talk about Mr. Price because they released their earnings earlier today. Share price up about 10%, but comparable store sales at this point look as though they're heading backwards. Were there any standouts for you when you look at these numbers?
Yeah, I think in terms of Mr. Price, we did see a bit of a strong revenue growth, double-digit revenue growth. But when you do look at that number a little bit closer, you can see that it was boosted by the acquisition of Studio 88. And so if you remove the effect of that acquisition, you can see that, Mr. Price Group's core businesses only grew about 3.8% in terms of revenue. And as you correctly mentioned, from an earnings per share perspective, there was a little bit of a drop, about 10% or so. And really the key drivers, they continue to be issues on more of the energy supply side of things, where they essentially last year had to spend, or throughout this period have had to spend to try and make sure that their stores can still operate during load shedding. In Q1, they had about 60% of stores operating during load shedding, but they have bolstered that up to 100% with a capital expenditure of about 140 million. And then on top of that, obviously from a demand perspective, they are beginning to see a little bit of slowing in demand. So inventory is beginning to pile up, and obviously having to try and clear that with discounts and the likes, and all of these factors really affecting profit margins, especially in such a competitive environment for retailers.
Speaking of those retailers, what's your assessment of the local retailers right now as they battle, load shedding and a consumer that is actually shopping around for bargains or is either under stress?
I do think it is a bit of a tough environment for retailers, both on the revenue side, as you correctly mentioned, from a consumer demand propensity perspective. There are a couple of headwinds. Of course, unemployment, we did see it improve, but it's still fairly elevated. And then from a consumer disposable income perspective, the high interest rate environment having an effect there in terms of squeezing consumers from a disposable income perspective. And on the cost side, when you're looking at some of the issues that they continue facing, just similarly with what we mentioned, Mr. Price, from a load shedding perspective, but also other issues when it comes to the logistics and transport and really the supply chain disruptions that are happening there. And of course, these increased costs, but the challenge for retailers is passing those costs on to an already constrained consumers, meaning that they will essentially have to take a bit of that knock.
Let's take things stateside for a bit and talk about the Fed, because we've got this market that's anticipating Fed cuts going into 2024, probably mid-2024. But I want to get your sense in terms of what developments do you believe have been largely ignored by the market right now?
I do think the large narrative at the moment that, of course, the Fed is also, at the heart of it in terms of trying to say that they are negotiating a soft landing for, the U.S. economy. We have seen the U.S. economy surprising fairly positively when it comes to the economic growth, personal consumption expenditure, surprising positively when we're looking at the latest GDP numbers. So there is still a little bit of resilience, but you are looking at some indicators that are beginning to show some signs of slowing. When you're looking at the manufacturing sector in particular, that is beginning to show some signs of slowing, not only in the US, but in fact globally when we're looking at some of the trends in terms of the latest PMI numbers. And I think when you go to other regions, particularly in the UK and the EU, you can already see some of the pressure when you're looking at the latest GDP numbers, that there is a bit of a contraction and a slowdown when it comes to personal consumption expenditure, and also a slowdown when it comes to manufacturing, with all manufacturers, of course, stating that demand for new orders is beginning to slow down.
All right, Simpiwe, let's leave it there. Thank you so much for your time. That is Simpiwe Litlojana, who's an investment strategist at ABSA Investments. And as we wrap up, looking at the Brent crude price, 81.03 to the dollar. And this is coming after OPEC Plus has postponed its meeting to next week, Thursday. And what we're hearing is that there seems to be a lack of consensus from the producers in terms of production levels as well as output cuts. But we will be keeping an eye on that. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.